Good morning. This is Japanese Economic Review Channel. Today we review the significant market shifts from yesterday, Wednesday, July 29, 2026. It was a day defined by a clear divergence. Capital retreated from high-growth tech and semiconductor sectors while finding a home in value-oriented, traditional assets. This rotation created a unique dynamic where major indices like the Nikkei fell sharply, even as the majority of individual stocks actually rose. Yesterday's session was a tale of two markets, showcasing global tech contagion alongside old economy resilience. While the Nasdaq's 5-day slide continued to pressure Japanese tech-heavy stocks, the broader market remained surprisingly firm. In fact, 25 out of 33 Japanese industry sectors finished higher, demonstrating that the heavy sell-off was concentrated in specific segments rather than being a systemic market collapse. Let's look at the final tallies from yesterday. The Nikkei 225 dropped over 930 points to close at 61,434.19, while the TOPIX managed a 10-point gain to end at 3,974. Across the Pacific, the previous night's U.S. session saw the NY Dow climb over 537 points, while the Nasdaq fell for its fifth straight session. Meanwhile, the yen trended stronger, with USD JPY closing near the 163.60 level. The primary driver for the U.S. market leading into yesterday was inflation relief, sparked by a 3-day decline in crude oil prices. This buoyed traditional consumer stocks and Boeing. However, persistent structural weakness and tech fatigue in the AI and semiconductor sectors weighed heavily. Significant losses in stocks like SanDisk and Micron Technology set a negative tone that directly impacted Japanese tech exporters yesterday. Yesterday's intraday path was dramatic. The Nikkei hit a trough at 1345, dropping to 60,448, the first time it breached the 61,000 level since May 21st. However, short-term oversold indicators triggered a late-day rebound. Crucially, market breadth remained positive throughout the day. 1,044 stocks advanced while only 491 declined, confirming that the index drop was driven primarily by a few large-cap tech components. Sector performance yesterday highlighted a massive rotation. The Nikkei was dragged down by heavy losses in electrical equipment companies like Kioxia and Tokyo Electron. Conversely, old economy sectors like transport equipment, Toyota, Honda, and rubber products, Bridgestone, saw strong gains. Domestic sectors such as services and land transport also showed resilience, proving that the underlying economy remains robust outside of the tech bubble. Yesterday was a difficult stress test for growth stocks. The growth market 250 index broke below its critical January low of 676 points as the semiconductor sell-off soured investor sentiment. We saw significant declines in PowerX and Astroscale. In the IPO space, Webull had a strong debut, while iGrid Solutions saw its initial pricing strength erased by a subsequent sell-off. Beyond the ticker tape, companies continued to execute on long-term goals. Yesterday, we noted Kurita Water's Yatagarasu project for AI-driven R&D and Suzuki's launch of the Brezza SUV in India. Sumitomo Rubber's Sensing Core technology was also adopted for commercial buses. These developments suggest that fundamental business growth continues to move forward despite the current macroeconomic turbulence. In summary, yesterday confirmed 3 key insights. First, the tech contagion is a global trend originating from U.S. sector corrections. Second, domestic market breadth is remarkably healthy, with over 1,000 advancing issues. Finally, the rapid swing off the intraday lows suggests the market is actively searching for a short-term floor. Investors should remain focused on these sector-specific resiliencies as we move into today's session. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.